going to go with this video, to be honest. I'm just going to continue on from where I was. Or just finished looking at Coles. I haven't actually, I think the video's uploading as we speak, to be fair, so if you haven't watched it at this point in time. But if you are someone who stumbles across this video, do me a favour and please like and subscribe. Try and grow the channel so we can maybe, hopefully one day, have a blueprint for people to see on whether or not somebody with no experience like myself, no education in finance, I don't know anybody in finance or anything like that. I got no qualifications in finance. So everything I do is completely self-taught, and trying to hopefully get to a point where I can become a successful value investor. I'm a value investor, and for people that want to do this themselves in the future, hopefully we can leave them a blueprint and able to do it from these videos and my journey. That's the plan. Obviously, I've got to become a successful investor for that, but, you know, time will tell. But yeah, if you could please like and subscribe and grow the channel a bit, and the more we can grow the channel, the more videos I will be able to put up. So just give me a bit more, me a bit more time to be able to do it than what I've got currently. At the moment, it's fortunately something sat a bit further back in my scheduling, so you know, we'll see. But so yeah, please like and subscribe, and we'll continue on now. I just finished on the end of the last video looking at Coles. I think it's a buy yet. I actually think as well that we're probably looking at beginnings of a rejection here in this area here. There's definitely something in this area here historically broken through, bounced off, sort of got a slow down of orders here as well before it breaks down lower. So we're back here now. Wouldn't surprise me if we started to see it go lower again. This is definitely on my watch list if it gets lower. I'm not really interested in this price, but certainly if you're looking around about down here again, then yeah, I would be interested in it. That was the essence, I think, of my video. I can't remember, it was a few days ago that I actually recorded it now. So yeah, we're just going to continue on going back down through my screener list, see what we can find. I've also got this quick take spreadsheet to help me pass a very loose screen effectively. I'm looking for this is stuff I've taken mainly from Mohawk and Lee Lu, heavily influenced by Michael Burry and Joel Greenblatts as well. Standard, you know, value investor heroes. But I would say that this is majoritively Lee Lu and Mohawk. I would say it's a loose screen, so my screener will bring it up, and then I will determine whether or not there's a big enough margin of safety straight off the bat to see whether or not it's worth continuing on with. Otherwise, I'm not overly interested, and I'll just move on. I'm trying to take a leaf out of Mohawk book where I say no as fast as I can. Lee Lu says the same. You know, in his Bruce Greenwald lecture, he was saying about how you really need to say no fast. Now we got the he was having to do it by going through value line. The essence of that lecture, from what I gathered and from what I've read online about what people stated about the lecture, is that he was using return on deployed capital as a, is this a good business, is it not? If it isn't, then, you know, goodbye, effectively. So sort of merged him and Mohawk. They're pretty similar though, I suppose, in there, because they're good friends, aren't they? Charlie Munger set them up together to, you know, regularly meet up. When this is back when they used to live in the same area. Mohawk openly talked about it in his videos, very giving with some of his knowledge on his YouTube channel, so definitely worth checking that out. Yeah, so Lee Lu was looking at stuff with a high return on capital. Now I've used Joe Rogan's return on Joe Rogan, you know, not Joe Rogan. Joel Greenblatts return on capital here from his magic formula up here. So using EBIT unlevered. And I've also just got a return on capital from simple free cash flow as well. So that's this one here, though. This one here specifically is like the engine of the business is before debt, before taxes. Is it a good business? Now, that's a Lilu thing. Very Joel Greenblatt as well, actually, which is why I've used that. There's Joel Greenblatt's return on capital and Lilu's return on deployed capital are very, very similar. They're effectively looking for exactly the same thing. So I've used Joel Greenblatt's one mainly because I stumbled across it earlier than I did Lilu's. Lilu's is actually slightly simpler. Definitely worth checking that out if you can. On his lecture, he talks about it on the lecture. There's also websites that have actually wrote down, taken the lecture and put it into Word format on a web page. It's on a Substack, I think I found it. But yeah, they're looking for good businesses. Monish Prabhai is looking at the good businesses that could try and pay him back within 3 to 5 years from their earnings. So that's why I've got cash flow multiples down here as well. So EBIT and simple free cash flow, which I'm using as instead of earnings, just because simple free cash flow I believe is better. I've got tangible book value up here, which I use as a proxy for liquidation value. It is not, by all means, it is not entirely accurate, but this is a loose screen, and then if it passes this, then I'll bring up the balance sheet and we'll actually have a look at it properly, because I want downside protection. Now, I've had a few conversations with AI. I mainly use Grok. I used to use ChatGPT, but I switched over to Grok lately because I'm not so keen on ChatGPT's rollout of, is it version 5 or something like that? Not been so keen on that one as I was version 4. I'm sure something like that, version 4. I really like version 4, but version 5 I've not been so keen on, so I wasn't really getting some answers that I liked. I found some of it was a bit wrong, so I moved over to Grok, and I found that Grok, it takes longer to get an answer back. The answer tends to be more accurate, so I switched over to that. But in this conversation, I was basically saying, like, what would Michael Burry, Lilu, Monish Prabhai, would they, what, price to book or tangible book multiple would they use on their screens? Now, they all came back, Grok came back unequivocally to say that effectively they want to buy something that's not trading anymore on about 1.3 times tangible assets. Because, should shit hit the fan and company go bust, if you are a major shareholder and there's not a lot of debt, you could get something back out of that, So yeah, I'm using tangible book value as a liquidation thing. I've got multiple tangible book value down here. I've only put it down here because I bloody forgot to put it up here, and all my conditional formatting, if you drag it up there, changes my conditional formatting, and at this point in time I can't be bothered to change it. Pardon me, can't be able to change it and redo my conditional formatting, so it's stuck down there for now. I will move it up because it makes much more sense to be up there under tangible book value. Yeah. So loose screen, downside protection, tangible book value for liquidation value, multiple less than 1.3. Return on capital needs to be quite high for the industry or the sector, and then earnings multiple, I want it to be quite low as well. I want it to pay me back as fast as possible. So if it passes this loose screen, we'll jump into it. Now, this loose screen is actually very similar to what Lilu was talking about in his Bruce Greenwald lecture, so that's where I've taken it from, effectively. I've got here, look, so when I've got, return on capital, I've got here, this is supposedly, good business average return on capital. The only problem with this is it doesn't actually break it down far enough for me. I'd like it to break it down into more sub categories as well. This is just like a really overriding, really overriding one. So, 5 is terrible, effectively KSS for Coles. When you look at what, this is the problem. I don't know if it's specialty retail or products, but either way, it should be, they're saying like a good typical business should be having 35%. I think that's quite high, to be honest, but this has come from AI. Got a little checklist here. Has it got a good strong capital, payback period, tangible book values for your floor, margin of safety, 40 to 50%, low conservative intrinsic value, that's what I'm looking for, strong balance sheet, low leverage, consistent positive free cash flow. I'm not so bothered on this capital light thing, to be honest. This is just something that through the conversations that grok throughout, I'm not so bothered. I will invest in many things that are highly capital intensive. The downside protection is there. But yeah, this is one I heavily agree on. Businesses have to be understandable. I just got this here as well. I took this from Wikipedia, actually, I think, where, so say something was 40% under intrinsic value, to get back to intrinsic value would be 60% upside, 67% upside, 50, obviously 50 is 100% upside. So I just got that there, just as a quick like look at. It's not really a necessity, this one here. But yeah, so what we would do is we're just going to go down through the screener. We're going to bang a few of them through here, see if it passes this loose screen, and then we'll see what happens from there. Now, the only other thing that I would check beforehand, before completely, saying no to it because it's not past this loose screen, is I will check on insider buy-in as well, because there's many reasons that an insider will sell. Generally, there's only one that they would buy. So, if I see a decent insider buy on something I'm not overly sure on the loose screen, I will probably dig a bit deeper because of the insider buy. Because who knows more about business, or who should know more about business than the people that are on the inside of it, I would definitely not be looking at stuff like this where it's only $407, one share. It's like really, really setting the world alight. I tend to want to see 250, 300,000 in internal inside buy-in. That is a number that I have borrowed from Roaring Kitty. Watched all his videos. Used to do it as like a podcast thing, really, on the way into work, because I got an hour's drive into work, so I just bang one on and listen to it over the radio while I was driving into work. But yeah, 300 grand is something that he said he likes to see, and that is something I've taken on board as well. It's a Monish Pabrai thing, isn't it? Being a shameless cloner, in that if other people are successful, why not try and copy try and replicate in some way method in their madness, Anyway, enough jammering on. I tell you what, I have an alert around about there. There's a few potential price stops technically on the way down. Anywhere between here and here. Yeah, I'll bang an alert on this expiration. Custom data, do it as far as I can into the future. We'll see. Coles, I just don't like at this price. Doesn't mean that I don't think that there's potentially value there. Right, moving on. Jesus, look at this. Not really keen on this already though, just from the price action. But digital outsourcing services, omnichannel delivery model. Okay. Like I said, we'll just bang it through and see. Task. Boom. Okay. Current price. No. No downside protection on assets, at least. 46% return on capital from EBIT. Yeah, really bad year here. Look, we should drag that average right down. 6-year average. I want to turn it into 7. I will do eventually, but we're dealing with what we got here because I'd rather use my spare time at the moment to crack on and look through some stuff as opposed to building out my spreadsheet a bit better. These not too great. 5 years, it's not too bad, I suppose, but then simple free cash flow there. Now this isn't, I will say, this isn't my simple free cash flow calculation. This is why she's simple free cash flow calculation. I will take a couple extra things, subtract a couple extra things from it, like stock-based compensation, stuff like that. I think that's pretty standard for a value investor to be subtracting that sort of thing. So, like I said, my simple free cash flow will be slightly different than this. Keen. If I want to understand the business, what I'll do is I just bang it into Grok and get Grok to explain everything to me. In layman's terms, whatever, sorry, I keep bloody yawning. Every time there's a gap at the moment, I'm yawning. 6-month-old baby, lots of sleep is hard to come by, and I'm generally having to do this late at night. It's literally 10 to midnight at the moment while I'm recording this. We'll see, 16 minutes in so far. See how long I can stay awake. Yeah, I'm not overly keen on this already. The return on capital is pretty good. Not a problem with that. Simple free cash flow, though, declined 3 years in a row. The tangible book value has grown massively there, though. It must have been negative before. I tell you what, though, this has come down as well, hasn't it? Although simple free cash flow hasn't, so there must be a lot of shit added back in. Do we just have, I don't know, should we have a quick look or not? Or is that defeating the point of saying no quickly? Let's just see if there's any insiders buying. Generally find with technology companies there isn't. I don't understand why, they just don't tend to do a lot of that. What's going on? Am I right on here? Is it there? TaskUs Inc. Any other owners? Why it is open inside. Be good, is it? Not good for the video. Any owners with any conviction? Got 2 of 100%, so I'm guessing they're probably involved. There we go. Took his time, didn't it? Sweet ass time. 8%? Yeah, they go done. None at all, basically selling everything they're getting given. Dalton Investments, they've gone bigger on it. It's a new thing, is it? They do then, because they've got a reasonable level of conviction of video and stuff like that. Okay. Probably going to pass on that. Just get a SEC fine. Okay, there we go. Financial statements, balance sheet. First, generally, I just want to see what the level of debt is there. You're 200 million. Let's come down. Total assets, total liabilities. Okay. Intangibles and goodwill. Goodwill's gone up slightly. Intangibles come down. Have they had a write-off? Oh, wrong one. No, not by the look of it. just what I do is I copy and paste this. You not calls, is it? Task US. There was no TaskUs. See what the business does. I'm not keen already because there's not enough downside protection at this price. Well, I say that downside protection for me either comes from liquidation value, occasional reproduction value, or just from sheer weight of cash flows. As we've seen, it's got a fair amount of debt. Where was it there? 200. So, half of the liabilities are long-term debt. Let's see what the schedule is. Got it. Long-term debt. What's all line of credits? Trader provider outsource digitally enable customer experience, specialized digital services. The company helps innovative brands, primarily social media, e-commerce, gaming, handle complex operational tasks that blend human expertise with AI and technology, next generation business process outsourcing, service delivery, global omnichannel cloud-based platforms, primarily fee-based contracts per hour, full-time. Flexible workforce. Is it 65,000 people? Never even fucking heard of it. Bear in mind, I'm not in the US, I guess, but focus on specialized services, fast growing tech sector. This company operates 31 sites. Revenue breakdown. Digital customer experience. I don't know. Seems a bit fucking out of my remit, this one. Just gonna ignore it and hope that it doesn't become a 10-bagger. GPK must have already looked at because I've got a colour on it. I've got a tracker here, look, where everything I've ever looked at gone through here. GPK on it. Yes, GPK is on it. Graphic packaging holding IMS. Return on deployed capital 30%. All debt is trading very closely to par despite an intense maturity schedule coming up and currently poor free cash flow. So, current debt schedule is well above their cash and potential free cash flow holdings. Debt is higher than most peers. Current close peers trade around 12 to 13 times. EV market doesn't appear to see a debt as a problem, but it's way too high for me. CapEx dropping as planned. Post new factories online and remains to be seen. Okay, yeah. Echo. This one I can't make my mind up on. I've looked at this one a few times. ACO brand, ACCO brands, whatever it's called. Basically make staplers and shit like that you'd have on your work desk, and not making money, but obviously it's cheap plastic crap that could be made in China, probably cheaper. So I can't make my mind up on this one. Certainly, if it continues to get cheaper, then it's got to be something I would seriously look at. I've done one, maybe two videos on this before previously, so we will see. Currently, it's just not really cheap enough for me, though. Anyway, so yeah, moving on. Oh, Shengfeng. That's got to be in China, as it found it. Yeah, China. Criteo, I've done stuff on that. CRTO, let's put a colour on that. Not interested in that. BRTS, investment asset management companies, I'm not interested in that. Angie, I've done. When I say I've done, so if they will be in a previous video somewhere. I've got a funny feeling this one's in a title, but yeah, this is what this blue means, that in the last quarter I have looked at it. This is stuff that I would be interested in later on. So it's on like a sort of watch list. Light blue is basically stuff that I've passed on recently. Red is I'm just not fucking interested in at all. Development, manufacturing, implementation, real-time offline, convergent billing, Israel, Harley Davidson. I looked at. Oh fucking hell! I was literally looking at it down here as well. 3%, pretty good. I wasn't overly interested in it. There's a change in the finance, something like that. They sold off their not majority of their finance division, but they're still gonna have a finance. I got a whole video on it. It was a vaguely interesting situation that has the potential for a lot of upside. I wasn't overly keen on my analysis of it, I guess, because it's the first time I'd ever generally been staying away from like financial stuff, unless it looks really, really cheap. And to stay away from technology companies as well. Doesn't mean that I wouldn't invest in them. Generally, the multiples are so fucking ridiculous that I'm not interested. I find it actually quite interesting that Mohnish Pabrai won't invest in technology companies, and yet that is his background. In Village Farms International, you'd done alright, wouldn't you, if you'd bought it down here? No. Engages in management and operation of agricultural greenhouse facilities in the United States. Now, that's something that's going to have tangible assets. What's going on here? Right down here. VFF. See what it comes up with, shall we? Yeah, return on capital is quite low. It's a negative as well. It's not too bad on, it's just under my 1.3 on price to tangible book value for downside protection. What's this? Minus 18. Something's happened in here, hasn't it? Negative for a long time. Just turned positive. That's what's happened. Oh, cannabis. Interesting. It sells electricity. What a wide scope for that. And they're not really interested in businesses that are so varied in what they do. It seems a bit. I'm not interested in that. Like, it depends on the type of business. Obviously, Berkshire, someone like that. Their fingers in many pies, but they know what they're doing. Foods. I looked at this as well. Came up with that. I've obviously put it in a look at it later. Cannabis operator. Fuck me, I'm yawning again. Heritage Global, corporate financial asset liquidation. Interested in that. What's this? Digital marketing and advertising solutions. Jesus Christ, what happened there? Positive earnings for the first time ever or something, wasn't it? See if you can get it. Nexxen, let's run it through here. Something's not right there, look. It hasn't got a 6-year, look. It's not old enough. No downside protection. Liquidation value. supposedly pay itself back in 3 years, though. So that in itself could be downside protection. Let's hit Nexxen. Not looked at it before, but look at it. Have a look. NEXN. Better be no insider buying. Technology company fucking never is. I don't really understand that, but why wouldn't you if you believe in your business? We've done here. Opening new pages by accident. This one here. See what inside here is. Is this going to load or not? Open Insider is shocking this morning. I guess it is morning. It's gone midnight now. There was a couple that are very invested in it. Did nothing. No insider buys. Where's the company based? Tel Aviv, Israel. That's why it's not coming up. So I expect. See if we can. No, I'm not even going to find it. It will find it, but I'm not interested. Then we'll keep moving. Mohawk Industries. Residential and commercial flooring products. Okay. Seems like a relatively simple business to be able to understand. MHK. And boom. Return on capital's piss poor. Get back to company's piss poor. Pretty good on the tangible book value though. Simple free cash flow shrinking. Your debt's quite high, 2.7 billion. It has come down though. Get Grog to explain it to me. In here. Copy paste this. New. Boom. Change this over. Fuck company again. MHK. Mohawk Industries. Where was I there? It's going to be like that, isn't it, surely? MHK. This is the only problem with Grok is you got to wait for this. Have a look what's on the SEC. And what's on the insider buying while we're waiting. We've done this year or not? I think so. Price opening insiders are slow tonight, man. Nexxen. Yes. I'll watch a fucking ad for it now. 100%, 57%. Yeah, we looked at that. Oh, Nexxen. What MHK then I? This shows you I'm tired of getting that. Okay, fucking think straight. MHK. Nexxen. Mohawk Industries. This is what we're asking about. You lost the plot then, didn't I? 11%. That's quite high, mind. 6%, 5%, 5%, 5%. RK Asset Management. Was that wrong key? It isn't, by the way. Typically concentrated, so it could be a value type thing. Okay. All sales, so it doesn't look good, does it? What does it say on here again? Effectively, the only thing it's got going for it is that the downside protection. Okay. Financial statement. I'll see earnings first. Let's just see what was left with to start with. Operating income's come down hugely at 200 million decrease. And there's not been a 200, there's only been like a 50 million decrease in revenues. Cost of sales have gone up 100 million. Okay. And I'm back. Honestly, I'm not going to lie to you. I was falling asleep during the end of that last section. I'm going to continue straight on from where I left off, but I could not stay awake. I literally sat in front of the computer and I dozed off. I was that fucking tired. So we're back on Mohawk. Grok is now loaded. I've also loaded it into my main spreadsheet and all that as well in that time, but just currently gonna fill out the right, here we go. Gonna fill out my tracker on Mohawk just to put it in there, even if we don't end up liking it, which we probably won't, to be honest. But it's better to have as many things in this tracker as possible. So current price 102.5. I think that's gone down since we looked at it. Let's have a look what the market cap in the EV is. Market cap 6.2 billion. 6.3 billion, EV 8.2 billion. So there's obviously debt in this. What was it, 8.2 billion? Let's have a look at this a minute. There's no insider buys, which I don't like. I like to see insider buys generally. Just all the way back. Like, you don't even need to do a big scope of this. It's just no insider buys. And in the last 2 years, no insiders have had enough confidence in this company to say, yeah, let's buy it. The only thing I will say, though, if we look at the insider institution, what have I done there? If we look at the insider institutions, there are a few that have a reasonable level of 2%. We'll do that down there, 3%. Have a reasonable level of confidence in this play. Right, Grog, because we had the business model up, didn't we? Let's open that up there. We can read side by side. World's largest flooring manufacturer by sales. Designs, manufactures, sources, distributes, and markets a comprehensive range of flooring-related products for residential, commercial spaces, and commercial spaces. Okay. Company's evolved over 2 decades from a primarily US carpet maker into a diversified global leader of operations. Well, pretty much everywhere then. 19 countries and sells, manufactures in 19, sells in 180 countries. So we'll just take the whole lot of that. Chuck it in the tracker. And in the business model section, vertical integration, controls the process from raw material production through manufacturing. Okay. Optimizes global manufacturing footprint. Mohawk reports in 3 segments. Here we go. Because this is a breakdown of the revenues as well, which is what I want to see. Jesus, that's quite a long-winded thing, but it explains what they are, so we're going to have to take the whole lot. It's going to fuck it down here, look. Oh, no, it's not. Right. This is a long-winded piece to put in here, but should I come back reading it in the future, you know, by geography? Here we go. So, majoritively in the US. Third of the sales are in Europe. Major categories, is that not already on there? Ceramics 40, 35, 26 is slightly different than what they're saying there. Doesn't matter. Did I take that? I did, didn't I? 19 countries, 180 countries, 78 manufacturing facilities. That's less than. You go, how's that right? Operates manufacturing facilities in, in 19 countries. Now it's telling you how many they've got. Right, okay. So we'll drag that in as well, because that's worth knowing for the future. Vertical integration, brand strength, geographic diversification with heavy emphasis on the US. Okay. Let's have a look at the balance sheet then, shall we? Drag it up over here. 10k, I've had this up before, I think, in the last part of the video. I can't even remember what happened, I was that tired. So just look at it with fresh eyes, and I'm sorry if you're double watching this, but worse things happen at sea, they say. 856 million cash. That's no billion. 2.66 billion. 2661, we'll just leave it like that. Too many. EP&E. 4772. Be interested to find out what that consists of. Total current assets, 6 billion. 5967. You haven't got to be entirely accurate on this. This is just ballpark figures. Goodwill and intangibles, quite a more than that. 1.2 billion in goodwill, 700 million in 700, 820, 800, what should we say then? 2.03 billion. That's a lot. Current liabilities to 2772. Just trying to work out a deployed return on deployed capital from a LILU calculation here. Long-term debt, I got that wrong. Long-term debt less current portion 1741. Total liabilities 5308. So leases in this. Current operating lease, yes. Long-term operating lease. About 400 million in total. So they must own the majority of their plants then. Book value. We can just drag it off screen because we can take that from here. Book value. Here we go. Where are we? 8378. 8378. Tangible book value 6355. So return on deployed capital is, now go get the graphic calculator out. To be honest, I could just take the Joel Greenblatts thing here, look. 6%, not very high, 6.4%. Quite low. Have they got any bonds? Let's just fill out the rest of this first, shall we? We want operations. I'm literally just doing this for my tracker. Now I think 10.8 billion. Just under. I said we're not operating income 490. We're just getting in the ballpark. Net income. Net earnings attributable to Mohawk Industries 370. It's twice now I've done that. Interest expense is quite low. That is quite low. Operating cash flow. I'm just going to keep doing that. It's dragged over the top. Operating cash flow 1056. 1056. CapEx 440. Free cash flow then is around 600, 610, is it? It's just ballpark. EV multiple, so enterprise value was 8.2, so 8200. 8200 divided by 610, 13 times. So I'm not really interested in this already. I can buy 6.3 billion worth of tangible book value for 8.2 billion. So yeah, not really interested. And the earnings, let's just make sure I am correct on that. Simple free cash flow 708. I've got, because I take out the stock comp on this. This is more accurate than this brief overview. The stock comp is in the other one. I'd imagine that's the difference. What they say it is. Free cash flow 610, and I've got it at 608. Okay, it's not that. It's not wildly out, is it? Yeah, 13 times EV is what we said. 15 times on. I'm just not interested in it. It's too expensive. If I'm looking truly for, you know, being a great cloner of Mohnish Pabrai and Lilu and all that, I need to be looking for stuff that's going to pay me back in 3 years. I feel like Joel Greenblatts is in that ilk as well, because I remember him saying that if you're not right within 3 years, you're probably wrong. And now that doesn't necessarily mean that he wants to be paid back in 3 years, but it's, I don't know. I don't know what I'm trying to say with that, but it's just interesting that he stays 3 years and then Lilu, specifically Mohnish Pabrai, is asking to be paid back in 3 years. Now, this multiple here, in case you weren't aware, tells you that if you were to buy out the company, which is going to be the market cap plus the debt, because if you buy the company, you own the debt as well. So you're going to end up not just paying 6.3 billion, you're going to end up paying 8.2 billion because you're going to have to pay that debt. So you're going to buy a company for effectively 8.2 billion. It's going to generate around about 600 million in cash, and it's been higher. It's going to take 15 years to pay that back, 13 years to pay that back. So for me, it's not something I'm interested in. The tangible book value, proxy for liquidation value, yes, all right, we are now below it, but not considerably below it. And the cash flows themselves are not going to pay you back for 13 and a half years. So currently too expensive for me, this one. I mean, I could be looking for stuff that doesn't exist, but I say, no, I'm not looking for stuff that doesn't exist, because I have found it. I have found these companies that do exist like that. In some of my videos as well, actually, I believe. In my earlier ones, I haven't found anything for a long time now, and I owned Olaplex, which sold to, I can't remember who it is it Schwarzkopf or Swarovski or something like that recently. So I have got a bit of money now that I'm looking to invest. So we are not trying to find stuff for the sake of trying to find stuff. I am actually now trying to find something to park that capital, because I did reasonably well on that. So yeah, I am trying to find a position to actually take a position in something, but it needs to meet these probably quite strict criteria. But these strict criteria of what kept miles better investors than me in the game for a long period of time. So shamelessly cloning is what I will do, as Managed by Bright calls it. For those of you who don't know, my favorite investors, Michael Burry. These are going to shock no one if you're into value investing. Michael Burry, Joel Greenblatts, wrote some very good books actually. Mohawk Industries wrote a pretty damn good book as well. And Lee Lu, but trying to find stuff on Lee Lu is quite hard. I just really liked the lecture that he gave in Bruce Greenwald's class in the early 2000s, found it very insightful, which is why a lot of my tracker now has got this return on deployed capital. I mean, we could do a bit of forecasting, I suppose, couldn't we, just to see what's going to go on. It'd be interesting to know, actually. This one here. So free cash flow has dropped consistently. Just to see what the working capital was. Oh, Jesus. So inventory staying on the shelves about 6 days longer. They're taking 5 days longer to collect their payables than what they were last year. And they're paying, providing this data is correct, we can check it. They have more than double the amount of time it takes for them to pay their payables, which means the cash is staying on the books longer, which is actually boosting free cash flow. So free cash flow is being overstated by payables. If that is correct, accounts payables and accrued expenses, 7105. I don't think this is correct. I don't think it is correct. 7105. Tell you what, I'm looking in the wrong fucking place. It comes off the balance sheet. Payables 2.3 billion. That's 300 million more than what it was last year. It's right in it. Questioning myself now. Day sales payables. How long it takes for average company to pay off its debt. I haven't actually wrote the thing, and that's accounts payables divided by cost of goods sold. By the look of it, C8 divided by C9 times 365 for the days. So DSP has gone up significantly. Anyway, that's a bit of a red flag. Well, that's a huge red flag for me generally when something's increased like that. That hugely. Yeah, so I'm going to pass on this because it doesn't meet any of the strict criteria I'm now setting for myself. But interesting because I've got this now in the tracker, so if it comes up cheaper, what does the chart actually look like? Sort of range. Oh, I'll tell you what. No, not that I. Well, they've done this now. They've changed it. Oh, it just tells you in the image. Not that I put any actual credence on technical analysis, but you have got this look. Where would it be? Maybe there, because yeah, that'd be halfway through. And then that would then meet up this side over there. Dropped out of it here, retested it, went to the top of it, down to the bottom. Now, technical analysis would tell you that the next most likely position is going to be up here. But you've had a lower low. We appear to be breaking out the bottom of this channel. Is it trying to break back in? Got a zone in here, look, of price. there. We are above that at the moment, actually. All right there. There's credence, look, to it. Bounced off of it there. So they got to say for themselves. Maintained in line, so they're basically saying it's fairly valued. What multiples it historically traded at? I mean, that's a huge one there, but it does, doesn't it? EV to free cash flow. 11, 12, 35, 37, 15. It would appear to be slightly overvalued, maybe, compared to what it was historically. Can't take this year here seriously, because obviously a bit of an outlier. Something's happened in that year. Simple free cash flow fell off a cliff, and anyway, just talking for the sake of talking about it now, because I already said that I'm going to move on. I will light blue it to say that I've looked at it in this quarter. GLOB, Globant S.A. engaged in provision of information technology services. Luxembourg, not generally interested in technology companies. And as I was saying earlier in this video, that I find it quite interesting that Mohawk Industries, whose background is in this, is not interested in it either. Technology. Return on capital is reasonably good. 13 times, no potential downside protection. So that's not cheap, is it? $11 times cash flows. You're going to get fucking hammered if it goes into liquidation because they've got no hard assets. Graphic engineering, games as service, DevOps. Fucking hell, I don't understand it. You've got to understand the business as well. Right, that's one of the first things that Mohawk Industries says is understand the business. So we're going to pass on that. VYX. Okay, provision of digital e-commerce. Atlanta, Georgia. Well, that is interesting, isn't it? Because look how high it was historically. Now the first question is, can we understand the business? It's VYX, let's bang it into there. So negative tangible book value, don't like that. Debt. Simple free cash flow, supposedly. No, it's negative, that's why. It's just not earning any money, hasn't earned any money last year as well. I mean, they went from a reasonably profitable company to earning nothing. This is just a quick take spreadsheet, this, by the way. You can tell it's called a quick take spreadsheet, but just going to give me a brief overview on the things that I want to see, like a cash flow multiple, tangible book value, what return on capital is. And just from those few things, I've decided that I can say no quite quickly to something. As you can see, negative free cash flow. All this data is pulled out by sheets, as is my main spreadsheet, but just like I said before, it goes into a bit more detail on the main spreadsheet. So yeah, revenues have fallen as well. Look. Revenues have fallen by 150 million, but free cash flow has fallen worse than that, considerably worse than that. Current assets are down, current liabilities are down as well. Current ratio is going to be negative, which is not uncommon for technology companies. 1.6 billion in debt, yeah. Got interest expense on here or not? I must have it down here somewhere. No, I don't know. We're just going to pass on that and say no. Not even going to financial statements, just a no. Jerash Holdings. Ready-made sportswear. Knitted fabric and personal protective equipment. Now they are considerably higher. 2018, May 2018. So there is enough data for me to get. So it is JRSH. So negative free cash flow, positive, then negative. Tangible book value is significantly below price though. So there is some form of liquidation value in this company. Could be worth looking into, couldn't it? Because we got some form of liquidation value. A reasonable return on liquidation as well. Well, not, and it's not liquidation, right? It's not, it's just a proxy for liquidation. You could go into and find out the assets that they got are worth considerably less. So when I'm saying liquidation value, it is a proxy. It's not me saying, oh yes, there's 497 in liquidation value, because it could be wrong. It's a proxy. I'm using it as a proxy in this quick take spreadsheet, because liquidation value is very hard to figure out unless you're actually looking it up. JRSH. Thank you, interactive data. Let's have a look at the balance sheet. Always start on the balance sheet. It's the most important thing. 56. So cash is 11.4 million. Inventory is 26 million. They're down on what they were last year. Advance to suppliers is up. Total current assets is up. Restricted cash is around about the same as last year. Total assets is slightly up. Credit facilities, so that's debt. Other payables. Current liabilities, so total liabilities there. So what have they got? Like all their liabilities, what is in here? Property, plant, equipment, 23 million. 24 million. Goodwill is worth nothing. Cash is half of your total liabilities here, mind. And property, plant and equipment, supposedly, on that alone, if you'd settled all your liabilities, you'd be 4 million up. Operating lease, nothing. Goodwill, nothing. Okay. What's going on with the cash flows then? Net income is up, so why has it gone negative? Changing in operating assets, accounts receivables, payables. Inventory, changing in operating assets. What has happened to the inventory compared to last year? Down a million. As you can see here. Payables was high last year as well. Not that that would have materially changed it. It would still be negative on operating earnings. Purchase PP&E is way up. Payments for constructions of properties. So what are they trying to grow? Pay dividends as well. Not high. 0.5. And they can't, problem is they can't afford to pay dividends. 20 cents there. Okay. What we will do, this video is an hour long now at least. I can't believe when I started doing this, I was doing like 2-hour, 2.5-hour videos. I want to go back to doing that again, but it's already midnight. I got work tomorrow. Life is making it quite hard at the moment to be able to do something like that without royally screwing myself over in the tiredness department, which is annoying effectively because I want to be doing this more, a lot more than I do. I want to do this full time. That's the whole point of this vlogging, this journey, but at the moment I'm just fitting in bits when and where I can. What is the first question I normally ask? This one here. Not Mohawk Industries anymore, it's Jerash Holdings. Ooh, it's the J out. What? JRSH. Well, we're waiting for Grok to find that. Let's have a look on here. Any insider buying? Considering you can buy it for less than tangible. No insider buying. Bit shit. Maybe we should just buy it just to shut it down and get that extra 4 million on the PP&E. Nobody. This is not good. I don't like this as well. Literally nobody's interested in it. The positions are tiny. Percent portfolio. So this geezer owns got 100% of his. So what is he? Well, there's nothing on here to find out. This is probably telling me all I need to know, to be honest. There are 22 people who supposedly invested in this. None of them have a position of any importance at all other than this one guy. So what is the 497? So it's trading less than, let's say, trading less than tangible book. Pardon me. Seems to have found a flaw in this area. But obviously that is going to continue to shrink if the earnings are terrible. Should we put it in the main spreadsheet or not? Ooh. I don't know. Let's see what Grok's saying about the business. Company produces garments, vests. Its major customers include brands such as the North Face, Timberland, and Vans. Okay. It's a contract manufacturer of customized ready-made sportswear and outerwear. So they make it for these people. New Balance, G3, Power Group, Hugo Boss. Functions purely as a contract manufacturer, not a brand owner. Sales occur via individual purchase orders from sample approval. 6 factories and 4 warehouses in the Al Tajamut Industrial City. Delaware. Oh, it's Delaware Incorporated. So it's not in Delaware then. Just incorporated in Delaware. One operating segment. Revenue breakdowns. 64% from VF Corporation. Who the hell are VF Corporation? Brands such as the major customers include VF Corporation. Okay, North Face, Timberland, and Vans. Is that right? We got that. Vans shoes. The Wikipedia page, yes. Van Doren Rubber Company. BF Outdoor. Okay. They're building this stuff at a loss for them, is what we're saying. 6 factories and 4 warehouses, 6,000 full-time workers, expanding capacity for new facility acquisitions and construction. Carries risks typical of power and contract manufacturing, heavy customer concentration, cyclical retail demand, geopolitical tensions, portable segments, one reporting segment, revenue breakdowns. We've done that. Sorry, we've read all that, haven't we? Destination geography revenue. So 88% goes to America. Let's just ask it to explain its free cash flow to us because it's very poor. Right, so free cash has been very poor the last couple of years. Is this a recurrent theme? And if so, how long can JRSH expect to remain in business? TBV is positive, suggesting. What is that suggesting? It is. No. There's money to be made by purchasing and selling off the assets, but true free cash flow looks very poor. See what they want to say about that. Anybody saying anything about it? Sell, buy, August 2023, so no one said anything about it for a while. 2024, what's the price in 2024? Up here? No. No, down here. So this geezer's not actually not lost, not gained. Here's around about where it was. 2024. Come on, Grok. Shut that one. Is there any bonds? I don't know if they'll be traded over here. I say over here in America, considering it does not appear to actually be in America. Where is it? Jerash Holdings Manufacturing. It located in Ammon, Jordan. Yeah. So it's truly, truly just incorporated. Negative, negative, positive, positive, negative, positive. Very highly positive. Research. No, okay. It largely reflects deliberate heavy capital spending on factory expansion, capacity growth to support rising customer demand and revenue. Okay. Yes, it's solid positive, provide a meaningful floor. Stock rates well below TBV, so in hypothetical liquidation, there could be value in selling factories, inventory, and other assets after liabilities. It's not pursuing liquidation, they're actively investing for growth. No, I get that, but for me, that's downside protection. Company explicitly states in its latest 10K, cash on hand and cash from operations are sufficient for the next 12 months. Working capital needs, there is no going concern. Liquidity is supported by strong working capital, 30 million cash buffer. So, yeah, there is current assets by current liabilities. Oh, really? Total liabilities are only... Yeah, but it was like that last year as well. Access short-term credit facilities, board expansions, plans to call further capex for capacity primarily by debt, not equity dilution or cash burn to threaten solvency. Bottom line, Jerash can reasonably expect to remain in business for the foreseeable long-term, multiple years to decades, provided it executes on customer orders. Okay. But OCF alone is hugely negative. What are we looking at there? Accounts receivable. So they are owed almost what's this in US dollars? So it's just 5 million. Unaudited as well, mine, I don't like that. They're owed almost 5 million just from accounts receivable. Inventories are very low in spending compared to last year. Oh, bugger. Oh, what a dickhead. Sheet. Inventories have fallen as well. Where are we here? Advances to suppliers. Oh, hang on. Operating cash flow is not hugely negative. Any structural and unsustainable sense is temporarily negative due to normal timing-driven working capital swings that are already well explained in the company's latest 10K. These swings are common in growing contract manufacturing business like Jerash. Revenue is recognised on shipment, but cash collections lag by 14 to 150 days. I haven't got it in this thing, so I can't do the... Approximately system of independent financial aggregators. Full historical OCF for context. Full year 1.3. Okay, so it's a timing thing. Cycle receivable are collected. Is that reason it's negative? Okay. Classic timing, not operating. Okay, so I'm just looking at it in the wrong period then. Because this is Q3, was it doing 9 months? It makes sense, because Q4 and this sort of thing is generally the best one, I think. Negative is temporary growth-related working capital phenomenon, not a recurrent theme of poor operations. Okay, still looking into this more than I want to, I think. But it would be interesting just to pull up last year's 10K. Net loss. Add back in depreciation. I fucking hate that. It's too bit. I take away 2 million straight away. Accounts receivable collected. Inventories they paid out on. Accounts payable is up slightly. Okay. So it's about $1 million in PP&E though, even after all of this. I'm not overly interested in it, to be honest. This puts me off hugely, and nobody else is. I think I'm just going to fuck it off and move on. Yeah, I don't know. We'll move on. GRNT, Granite Ridge Resources. I feel like I've looked into this historically. GRNT is put in a quick spreadsheet. Quick take spreadsheet. GRNT. I've got enough data. Tangible book values trading below. Simple free cash flow is negative. EBIT's up though last year, but way down compared to historical years. Really interested in this either. See what anyone else thinks. Was it GRNT? Oh, buying. Interesting. Including this year and very recently. I've semi-small amounts. GRNT. Granite Ridge Resources. Anybody think anything of it? Hamilton Lane Advisors 31%. Georgetown University 6%. Nobody I've heard of or respect. In no disrespect to these people, but probably not interested in that either, to be honest. I'm going to leave this video here. About halfway down this list now. Yeah. Yeah, alright. I'm going to leave this video here. Thank you very much for watching. Sorry I fell asleep halfway through. Not that you would have noticed because I'll cut that bit out. Please like and subscribe to help grow this channel. Appreciate it. Thank you very much. And I will see you on the next one. Alright. Take it easy.